Hey guys, Britt here. Welcome to End Times Bible Prophecy. Make sure to hit the subscribe, like, share, and restack buttons. Well, right now, they're in a state of absolute panic. Who am I talking about? I'm talking about the world's central banks. And the reason they're in panic is because something is terribly wrong with the global financial system, the global banking system, and they know it. And as we've been over before, they're not going to tell us, right? They have their list of who they need to be transparent to, when they need to be transparent to them. And we're not on that list, right? We're on the list to lie to. So they're not going to tell us these things, but we're going to look at what the central banks have been doing, how they've been reacting, because a financial crisis kicked off in July. I believe when we look back, people will say that is when this began. We saw it emerge into the headlines the first week of August with the biggest two-day drop in Japanese stock market history. A lot of people learned about the yen carry trade for the first time as we saw that unraveling. And then everything seems to be fine since, right? It's all over, right? Wrong. The crisis continues, and we're going to look at data today showing, well, yeah, it never stopped. It's been simmering below the surface. Looks like something big may have just happened that they're preparing for. And so let's start with this right here. So this is a tweet from Global Market Investor. It says, global central banks cut rates as if there's a crisis. Well, that's because there is. It says in September, central banks cut interest rates 21 times, the most since the COVID shutdown crisis. This was also the third highest amount of cuts since the Great Financial Crisis, 2008-2009. Central banks are trying to avoid a global recession. No doubt about it. I'd say it's a global depression they're trying to avoid, but I think there's something else simmering below the surface because we've talked about there's a Great Depression that's coming. It's already locked in several nations. It's not completely global yet, but you can have a depression without a financial crisis, and you can have a financial crisis without a recession or a depression. But you can also have both at the same time, which is what we had during the Great Financial Crisis and the Great Depression. And it's what we're going to have again now. So there's things simmering below the surface within the banking system, within the global financial system, that they're trying to get ahead of the curve on. So if you notice, we saw the U.S. Federal Reserve cut rates on September 18th, I believe. So a couple of weeks ago, a little more than a couple of weeks ago. And there was all sorts of talk leading up to that. Will they cut a quarter of a point or a half a point? They cut half a point. And you have to ask, well, why? Why did they take such a big cut to start with, especially with stock market near all-time highs, supposedly unemployment's at these historically low rates, the economy's humming along, we're in a soft landing, everything's great, right? So why all of a sudden cut half a point? And why are all these central bankers cutting in ways that we've only seen during, the last couple of decades, during the Great Financial Crisis, the COVID shutdowns? Why are they cutting like that? And I think the answer is because we are entering this global depression phase. And in doing that, it's breaking a whole lot of big nodes within the financial system, within the global financial network. So remember what phase we're in. So this is the 2-year, 10-year spread known as the yield curve. And for 2 years, we've been saying, watch this. This is the big signal. This was an inverted yield curve, which meant that it went negative back in July 2022. So for the 2 years since then, we've been saying, watch this, watch this. When it goes positive and it stays there for at least a few weeks, then we know that's our signal, that's our sign that we're about to hit major turbulence, that everything's going to start falling apart. Well, 4 weeks ago today, I believe that was September 6th, this closed positive for the first time since July 2022. Every trading day since, it has closed positive. So we're on 4 weeks now of an uninverted yield curve, which has a 100% track record in the last 50 plus years. So going back to the beginning of the current monetary system, when President Nixon closed the gold window, that's the modern monetary system we've been on since then. Every time this is uninverted, it's led to a recession. So we would have to believe this time is completely different. It is not. And I believe we're going to get a financial crisis along with that. We're going to look at data that tells us, well, we're right there. It's about to hit. So let's look at this. This is from Business Standard. I believe we looked at this recently. Maybe not, because it's dated yesterday. So hey, sometimes these articles, they get cluttered in my mind, and I think, did I talk about this already or not? Maybe I'm talking to myself about it. But this says China plans to add capital at big banks for the first time in a decade. Oh, yeah, September 24th. So maybe it was showing a different date up top. But it says China is planning to recapitalize its biggest commercial lenders for the first time in more than a decade in a bid to strengthen the industry battling with record low margins, sinking profits, and rising bad debt. At a rare press conference on Tuesday, again, this was last week, authorities flagged they will increase the core Tier 1 capital at its 6 major commercial banks, along with a slew of other measures to shore up the real estate market and the economy. Capital will be injected into different banks in turns with different policies, said Li Yunzi, Minister of the National Financial Regulatory Administration, without giving more details. The regulator will urge big banks to enhance capital management capabilities and strengthen operations to better serve as a driving force for the real economy, he said. Guys, they're trying to shore up their banks, and they're trying to shore them up because they think something is about to happen. Yeah, and yes, they are in a state of deflation akin to the deflationary spiral the world experienced during the Great Depression. That's where we're all going. China is in that right now. So they're fighting that, but they made an abrupt change in their policies last week. And you have to ask, well, why? What has changed? What are they privy to? What do they know that we don't know? It says authorities on Tuesday announced a major stimulus push to shore up growth. The plan included a broad-based cut to existing mortgage rates, adding to pressure on banks by lowering annual interest expenses by $21 billion. Regulators also reduced how much banks need to hold in reserves and a cut to the key policy rate. Lee said that it has become necessary to add capital through various internal and external channels. It would be the first time since 2008. What was happening then? The Great Financial Crisis, that authorities have injected capital into one of its big banks, and the first time since they all became public companies. So I know some of this is using financial jargon, but they're giving cash to the banks. They're bailing out the banks that supposedly don't need to be bailed out. They're pre-bailing them out in anticipation that they're going to need a bailout. That's essentially what's happening. It says it's unclear how the state-owned shareholders, including the Ministry of Finance, will increase their stakes in the large banks, said Liao Ziming, an analyst at Huayuan Securities Company. Still, the plan shows regulators are urgently sending positive signals to support the banking industry by stabilizing its main force, the big banks, and serving the real economy, which is under increasing pressure with significant margin declines. And here's the kicker, and ensuring the prevention of systemic risk. So what is the systemic risk they're afraid of? Well, we've talked about global systemically important banks. There's systemic risk in the system when you have a large institution fail, and then that failure leads to what's called an increase in counterparty risk, meaning, well, I'm in good shape as long as all of the people that owe me money pay me back, right? But if they don't, well, then I'm not in good shape. That's called counterparty risk. So that's what they're afraid of. They're afraid of problems within the global financial system, within the banking system, that could destroy one of their big banks. So they're trying to shore them up ahead of time, basically a pre-bailout. So let's look at this as well. This is from Zero Hedge, talking about much of the same thing and what China is doing, because this is a signal of a panic from China and China's central bank. It says, China goes all out as Xi vows fiscal stimulus to save private economy, stabilize real estate, and boost stock markets. It says yesterday, and again, this is from a week ago, last Thursday. Yesterday, when describing the latest round of monetary stimulus out of Beijing, we said that China is not done stimulating, and boy, were we right. Global markets are sharply higher again on Thursday, fueled by hopes of more intervention just days after the central bank announced the biggest monetary stimulus since the pandemic. Again, a crisis time period. Why all of a sudden is it a crisis time period? It says, after China extended its stimulus barrage for the third day in a row and vowed even more support, including a pledge to intensify fiscal support for the world's second largest economy, as well as press speculation of $1 trillion renminbi of bank injections, that would be $142 billion in dollars, into its top banks, China vowed to save the private economy, stabilize its property sector from further slumping, boost its stock markets, and ensure necessary fiscal expenditures, according to the readout from a Politburo meeting on Thursday. So why all of a sudden have they just done this complete 180? They're taking all of these measures to try to prop up every aspect of their economy and the banks. What do they see coming? What are they afraid of? So this says, there was a sense of urgency, a sense of emergency intervention in today's Politburo meeting because, as Morgan Stanley analysts noted, the Politburo usually does not hold economic sessions in September, suggesting, quote, an increased sense of urgency about growing deflationary pressures. And guys, we've talked about this in the past. Many people are looking for inflation and continued inflation, but the real concern should be deflation, as we experienced in the acute early moments of the great financial crisis, as we experienced during the Great Depression. It says, but they said China's government did not yet appear to have reached a whatever it takes moment on the economy, at least not just yet. It says what was notable is that the meeting specifically mentioned to, quote, stop property prices from falling further. This is a dramatic contrast from the earlier mantra of a home is for living and not for speculation. So in the past, China's property market has been falling for several years now. They've had several large property developers fail. Many people have lost their life savings. And China has taken the approach that we're going to let this play out because there's been too much speculation within the property market. And homes are for living in. They're not for speculating. They're not for gambling. They're not meant to be bought and held for retirement. They're meant to be lived in. So it says economist, but the government has stopped short of announcing a fiscal bazooka as it has done during past crises, such as when it unleashed $570 billion in 2008, sparking a boom that reverberated through the global economy. The government was already planning to issue about 5 trillion renminbi, so a little bit more than $570 billion in long-term government bonds and special purpose local government bonds this year, but most of this was earmarked for investment in infrastructure or other projects. Economists estimate that given the much larger size of China's gross domestic product compared with 2008, it would need to spend up to 10 trillion renminbi, so twice as much over 2 years, to fully reflate the economy. With this going to households rather than big-ticket infrastructure or industrial projects. They warn that China is in danger of slipping into a full-fledged deflationary spiral as the property slump weighs on domestic consumption, even as investment in manufacturing rises. And I would say, guys, they're not in danger of slipping into a deflationary spiral. They're already in one. And God willing, on Monday, in Monday's video, we're going to talk specifically about this issue. But I believe these measures were also taken because they see that something is about to happen within the global financial system, within the global banking system, that poses a systemic risk, the emergence of a financial crisis that comes into the headlines. So let's revisit this article. We looked at this, I believe, last week. It says SEC slip-up hints at fresh financial fears. So I know that this is going over a few things that we went over in previous videos, but this sets the stage for what we're going to look at in the moment, which is telling us that something is going on right now as we're making this. So it says, oops, last week the SEC accidentally published internal commentary along with a speech by Chairman Gary Gensler. Here's one of the comments which was mistakenly included. Quote, I strongly recommend that a sentence be placed here or somewhere in the first part of the speech to reassure markets that you are not making the speech because you think there's an imminent crisis. So again, remember in the past when we looked at that 2022 FDIC, systemic resolution meeting where it's basically a war game where they sat down and said, if we have a major institution fail, major financial institution fail, maybe a systemically important bank, global systemically important bank, who do we need to be transparent to? When do we need to be transparent to them? What do we need to be transparent about? So here they are. They're discussing that. They're saying, we need to make sure that you put a sentence here just telling people, tell people there's nothing to see here. I'm not making this speech about a major failure because there's an imminent crisis and there's a major failure. But, so they say, right? It says these internal communications were quickly deleted from sec.gov, but not before the page was archived for posterity. The slip-up reveals anxiety among regulators over messaging. Yeah, because it's when you're lying, it's very difficult because you've got to remember, what lie did I tell before? Is what I'm saying now matching what I said before? Whereas if you're telling the truth, you just tell the truth. You don't really have to think about your messaging, right? You just say what's on your mind. It says Mr. Gensler's speech addressed financial crises, bank restructurings, and the importance of public disclosures. Because, talk about those things all the time with no intent that will ever actually have them, right? Says in it, the SEC chair rightly argued that depositors need transparency to make good decisions. Yes, they do, but they also realized that the good decisions for the depositors may mean going down to the bank and telling them to give you all of your deposits. They don't want that, right? So, as they said before, the public has a lot more faith in the banking system than those of us in this room, But, we want them to have that confidence, right? Because if they don't, it all falls apart. It says if a large financial institution is restructured, and that would change that to when, right, the market's need for disclosure doesn't go away. So they're sitting here talking about, well, how do we message this? Well, why are they talking about how they're going to message about a financial crisis, a bank restructuring, all of these things? Well, because that's what they expect to happen. So this says, why the imminent concern? Why are they talking about reassure people there's nothing imminent coming, right? Well, an SEC staffer was concerned Gendler's speech might give the impression of an imminent crisis. Well, because there is one, right? It says, whenever regulators discuss the solvency of financial institutions, there's a risk that it's interpreted negatively by markets. It's a valid worry. Unfortunately, in this market, there are some excellent reasons to interpret the remarks in a cautious light. Let's start with the latest data on unrealized losses at banks. So this is from the FDIC. I've looked at this chart numerous times. It shows that banks are sitting on $500 billion in unrealized losses. Again, they're unrealized. They're just on paper. But if a whole bunch of people show up at the bank and they say, give me my deposits, well, the only way that can happen is for these banks to sell these investment securities they're sitting on that are worth less than what they paid for them in order to give the depositor their cash back. And in doing that, then those unrealized losses become realized. And if enough of them become realized, no more bank. The bank is out of business. And to put in perspective just how bad all of this is, well, this little tiny blip over here, this is the great financial crisis. So it almost brought down everything. The whole financial world was coming to an end. Yeah, it was this little tiny blip over here compared to that. Now you might say, well, what is this? Well, we're going to look at that in a moment because that was the crisis that was coming until the pandemic just came along and very conveniently enabled central banks around the world to just print and bail out and create this, right? So, but then quickly all of that changed. It didn't last but so long. It only kicked the can down the road a little bit further. It says, remember when this chart was making the rounds in 2022, 2023? The updated FDIC data continues to show an unprecedented and sustained rise in unrealized losses at banks. And again, this is just U.S. banks. Globally, that's a much bigger number. It says, notice how small the losses during the global financial crisis appear in comparison. These are unrealized losses on banks' bond portfolios, primarily caused by the Fed's rapid interest rate hikes. When rates rise, the value of existing bonds fall. This is what caused the failure of Silicon Valley Bank, second largest bank failure in U.S. history. It says unrealized losses stand at $512 billion, as reported by the FDIC, down from a peak of around $655 billion. The data has improved a bit, but bank balance sheets remain stressed at historic levels. And again, this is what's reported on those bond portfolios. They have a whole lot held in these off-balance sheet entities and all these. It's a tangled web, an accounting mess where they hide things off of their balance sheet. It's a lot worse than what we actually see. It says ongoing interest rate cuts could help stem the unrealized bleeding at banks. As rates fall, the price of bonds will rise. But lower rates should also mean lower profitability for the lending side of the business, so it's somewhat of a double-edged sword for banks. Even if the unrealized loss situation gets resolved, there are other potential black swans to monitor. After all, why is the Fed planning to cut rates? Again, this was probably before they did. Apparently with haste, right? Half a percentage point. Are they simply trying to get ahead of bank losses and soaring debt servicing costs? Or do they potentially see a recession or a financial crisis in the near future? And the answer is yes, 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 right? To all of those. Let's review our situation. The Fed is preparing for economic turbulence. Gold is trying to tell us something as it powers to new all-time highs. Job growth for the year was recently revised sharply downward. Over 1 million jobs, they said, were created. Gone, right? And of course, they're also revising GDP lower as well. Oh yeah, that growth we told you we had didn't really happen. And now regulators are making speeches about restructuring large financial institutions. It sure feels like something is brewing. And the reason it feels that way is because it is. So let's take a look at this article, which I'm sure you're all aware of. Maybe not this particular article, but the story. Bank of America glitch. Right, so you've been following this channel for a while, you know that we've made note of these glitches in the past. They're not really glitches, guys. Their messaging is to tell us that it's a glitch, right? So the glitch that stressed customers coast to coast is resolved. So if you remember last year, they had a whole bunch of glitches like this globally, and it got so bad and so constant that they had to come up with new ideas because they were like, we can't keep telling people it's a glitch every day, right? With all these different financial institutions. So they had to come up with other ones. Oh, it's a cyber attack. It's a ransomware attack. And then my favorite was they said the system went down and a guy had stuff on a flash drive and he had to run down the street in New York to get that flash drive data down there, and then everything was fine. So guys, Bank of America had this glitch. I'm sure most of you heard it, but in case you haven't, they had a glitch with their mobile and online services on Wednesday that prevented thousands, it's really hundreds of thousands of customers globally from accessing their accounts, or if they could access their accounts, they discovered they had a zero balance, according to company officials and an outage monitoring website. But of course, their balances on the debts they owed, if they had credit card debt or mortgage debt or auto loan debt, oh, those weren't zero. Those all showed up perfectly fine. It was just the balances in their accounts that were zero. So again, a glitch. You know, we'll get into talking about this more as the days go ahead or go forward, but I don't think this was a glitch. And as of right now, so I'm recording this late on Thursday night because I've got a full-time job, so I can't do these things during the day. It takes a while to edit, it takes time to upload. But as of right now, we're over 24 hours since they resolved this. They have not said, as of right now, what caused it. They just said, oh, it was a glitch. Problem solved. Go about your business. Nothing to see here. Don't worry about it. What caused it? It's resolved. Just, stop asking questions. It's resolved. Everything's good. So they haven't told us what it was. And we can speculate on what some of those things might be. But I would say one of the primary speculation would be It was intentional and not a glitch, but we won't get into that right now. So let's look at what else is going on. So we read here, Bank of England allots £37 billion in weekly repo. So what this means is that's short for repurchase. So it says the Bank of England allotted almost $50 billion in 7-day funds and its weekly short-term repo on Thursday. So repurchase. So what happens is these banks go to the Central Bank of England. They say, we've got this government debt. We need cash. Why do we need cash? Well, because for various reasons, if we don't have the cash, we're going to be bankrupt, right? So they go, we're going to hand over to you this government debt, these U.S. treasuries, or, whatever, UK government debt, whatever it may be, and you're going to give us cash, right? And so this is a facility that's used when there's stress within the banking system and the banks need it. So that has been steadily going up throughout the year to the tune that the latest week was $50 billion. To put that in perspective, at the beginning of the year, it was around 2. So it's up about 25-fold since then, or maybe 20-fold. I'm sorry, I'm thinking it's around 40 billion in pounds, in British pounds, and it was around 2 billion at the beginning of the year. So it's up 20-fold year to date. 2022, 2023, most weeks this was 0, nothing. But now it's been ratcheting up, especially since we saw the yen carry trade unraveling back in August, so 2 months ago. I think the week before last was the first time that it hadn't been higher than the week before, because it had been a new weekly high for like 8 or 9 weeks consecutively prior to that. So there's a U.S. equivalent to this at the Federal Reserve Bank called overnight repurchase agreements. And here we have a chart that goes back to 2019. We mentioned before, we were looking at that unrealized losses. There was a slight downward move back in, let's go back and look at it real quick. So what was this? So if this was the great financial crisis, and this is right now, this is the this is the global destruction crisis of, the present day. What is this right here? Well, this was when the financial system almost imploded 5 years ago, right? Like I said, something conveniently came along, a global pandemic, and enabled them to print their way out of that crisis. And so here we saw what happened to these repurchase agreements at that time. So that crisis began September 17th, 2019. Prior to that, I don't think this facility had been used since the great financial crisis. But we saw it kept getting used less and less as we saw the COVID stimulus measures kick in and the central bank response to those lockdowns, until by the end of 2020, by July 2020, it was down to 0. And it's stayed 0 for years since then. Nobody's been using this, right? Nobody's been using it. And all of a sudden, let's cut this to 1 year. Something happened Monday to where all of a sudden we've seen, they're starting to use this stuff a little bit here and there over the past year, and then something big happened on Monday. Now that's still a big blip compared to what we were just looking at that happened 2019 and the beginning of 2020. But this signals that there are only so many banks that are eligible to tap this facility, and they're all big banks. So that tells me there was a big bank somewhere in need of cash. So there's something wrong in the banking system right now. And so let's take a look back. Let's revisit what happened back when we were looking at this stuff. What was happening back here that now, again, a little blip right now, but is this the start of something bigger, especially when we see convenient glitch this past Wednesday? But we can read a little bit about that on Wikipedia. September 2019 events in the U.S. repo market. It says on September 17th, 2019, interest rates on overnight repurchase agreements, known as repos, which are short-term loans between financial institutions, experienced a sudden and unexpected spike. A measure of the interest rate on overnight repos in the United States, the Secured Overnight Financing Rate, or SOFR, increased from 2.43% on September 16th to 5.25% on September 17th, which is when we saw that first being used. During the trading day, interest rates reached as high as 10%. So there was something broken in the financial system at that time that led to a liquidity problem. What does that mean? It means that the banks needed cash. They needed that cash in order to meet their financial obligations, or they were at risk of being insolvent, of being bankrupt. And so central banks came to the rescue. We didn't really learn to what extent until a couple of years later. So this article from back in November on Wall Street on Parade tells us a little bit about the extent of that and what happened. But central banks came in and gave trillions to these firms. It says, let's start with the repo loan crisis in the fall of 2019, which resulted in the Fed making enormous emergency loans to Wall Street trading houses. Again, trillions of dollars in loans to those Wall Street trading houses. It says on September 17th, 2019, the overnight loan rate spiked from an average of about 2% in previous days to 10%, signaling that one or more financial firms were in trouble. Liquidity became so stressed on Wall Street that the Fed began making billions of dollars in emergency repo loans available daily to 24 trading houses on Wall Street, the majority of which were owned by the mega banks. The Fed released on a daily basis the dollar amounts it was loaning, but withheld the names of the specific banks and how much they had borrowed that day or cumulatively. This made it impossible for the public to see which Wall Street firms were experiencing the most severe liquidity crisis. It was the first time the Fed had intervened in the repo market since the 2008 financial crash, another crisis that federal banking regulators did not see coming. And so if we scroll down, we can see here Deutsche Bank, Citigroup, Barclays, Goldman Sachs, JP Morgan, Nomura, collectively trillions of dollars in loans from October 1st, 2019 through December 31st of that year. This really didn't come to light until a couple of years later. So all this was done behind the scenes while they're publicly telling us everything's fine, everything's wonderful. And guys, we're seeing the same thing happen right now. We're seeing this repo facility being used not just at the Fed, but also at the Bank of England, because something is broken in the global banking system right now. This is playing out just as we noted that it would. We've seen that uninverted yield curve that we talked about back here. And that's our signal that trouble is ahead. And we've also talked here in this article numerous times about how the current global financial crisis leads to biblical tyranny. So this is from mid-August when we knew, okay, this crisis has emerged, even though it's left the big headlines that we saw back in early August, does not mean that it's gone away. The Bank of Japan is trapped. That means the Japanese economy is headed to destruction, because no matter what steps they take, they either destroy the currency or they destroy the government's ability to finance itself, and they destroy their banks. And we're talking about the fourth largest economy in the world. So we know that we're going to see continued volatility. We've seen that. We're going to see limited bank runs. I believe we're on the verge of seeing that right now. And a massive central bank response. Now, these steps don't have to come one right after the other. They can be ongoing. They can be mix and match. We've seen in China the massive government central bank response. They've done that. They know something is broken, guys. We're heading into the acute phase of this financial crisis. I'm telling you, this is going to emerge into the headlines in the coming days and weeks. I don't know the exact timing of it, but this isn't something that's 2 or 3 years away. This is something we're on the cusp of. We're monitoring this constantly. It's quite possible that we are on the cusp of seeing a major financial institution fail. And that's why China is taking the measures that it's taking and talking about preventing systemic risk. So there is something broken. And why does all this matter to Bible prophecy? Because as we stated, this is the opening phases of this 10-step process that's going to take us to a new system that sets the stage for the mark of the beast system, because it'll be indistinguishable what they roll out from the mark of the beast system. Something big is going to blow up. We're going to see a bank holiday. We're going to see the credit markets freeze. Everything shuts down. So we got a tiny, tiny glimpse, if you're in the United States this past week, of what that means when they shut down just the ports on the East Coast for 2-3 days, and what that meant. People rushing out, buying up all the toilet paper and paper towels. Imagine when everything shuts down. We didn't even see that during COVID. We saw a lot shut down, but there was a lot that still moved on. The delivery trucks still brought things from Amazon, and the grocery stores still had something in them. May not have been what you wanted to eat, but they had something in there. But what happens when everything stops? Not permanently, but for a week, 2 weeks? Are you prepared for that? You need to be prepared for that, because we could experience that if we're still around for all of this. Then they're going to roll out this new system with central bank digital currency, tokenized assets, digital IDs, and they're going to make that system mandatory. They're going to eliminate the use of physical cash. They're going to ban it. And at that point, you have a system in place already that's indistinguishable in capability and function from the mark of the beast system we read about in Revelation chapter 13. And at that point, to roll out the mark of the beast system, all you have to do is flip a switch. So the stage will be set for the tribulation, the rise of the Antichrist and the false prophet, to be able to roll out this system. Guys, all of this is setting the stage for that tribulation period, the second coming of Jesus at the end of that 7-year tribulation. And that means the rapture of the church is even closer, because I believe the Bible teaches the rapture of the church takes place before the tribulation. So guys, keep your eyes fixed on Jesus. Have no fear in these times, no matter what you see emerge in the headlines, no matter how bad it seems. Jesus is Lord. Yesterday, today, and tomorrow, no matter what happens, he still achieved victory. He still achieved victory over death on the cross. He died and paid the price for our sins. Guys, we should be filled with joy and hope, knowing that he will return soon, that we will be with him soon. So make sure you take advantage of whatever time we have left to tell as many people as you can about the hope you have in Jesus Christ. So what do you think? Leave your comments below. Bank of America, Just a glitch. Right? Just another glitch. They sure do seem to have a lot of glitches, though. All these banks. I don't seem to see as many glitches at, McDonald's, right? Or Taco Bell, right? You never see there was a glitch. Nobody could order anything at Taco Bell today or Kentucky Fried Chicken, right? But the banks, every time you turn around, they're like, it's just, your deposit's not clearing. It's the ATMs don't work. You're online. You have no access to your online account. It's a glitch. Glitch. Ransomware attack, cyber attack, another glitch. You buying any of that? Or do you think they're determining their messaging so that they can figure out, well, what do we need to tell these people? What do we want to be transparent about to the little people out in the public? What do we want to tell them? Let's go with a glitch. It's worked before. They bought it the previous 187 times we've done it, so let's just keep telling them it's a glitch. So are you buying it? Leave your comments below. Let me know what you think. Make sure to hit the like, share, subscribe, and restack buttons. God willing, I will see you on Monday. Bye. If you want to learn more about the end times and Bible prophecy, make sure to visit my Substack at brittgillette.substack.com. There you'll find my latest videos and articles, as well as notes, where I share the latest news headlines, the articles I'm reading, and the videos I'm watching. Subscribe for free, and each new post on Substack will be sent directly to your email. Just scroll to the bottom of the homepage and hit the subscribe button. As an added bonus, your first welcome email will include a link to a copy of my free ebook, 7 Signs of the End Times. Also, make sure to check out all of my books. Just look up Britt Gillette on Amazon, Barnes & Noble, Apple iBooks, Google Books, Kobo, or anywhere books are sold. Thanks for watching today, and until next time, keep your eyes fixed on Jesus, the author and perfecter of our faith.